It's great to be here today, and we're going to talk about the trading strategies that we're using this year that are working pretty well this year. In general, the market was not trending there for a couple of years, but now it's starting to break out. So our strategies are doing even better in this market that's starting to trend. We went so long without a trending market that it's good to see a trending market like we have this year. So we're going to look at the strategies that we're actually trading this year, and we'll look at actual trade examples to demonstrate the strategies. We actually have these trades on right now. We'll look at the weekly paycheck strategy, the stock spread strategy. We'll look at the directional option trade strategy, the option debit spread strategy, and the market neutral spread strategy. Let's look. The first strategy we'll look at is what we call the weekly paycheck strategy. And what we do is we sell weekly covered calls every week, and at the end of the week we close out the expiring weekly option, and then we sell to open the new weekly option, and we have a new trade every week with weekly covered calls, and that actually generates cash income every week as we sell those options. So the covered call strategy is implemented by buying 100 shares of a stock or an ETF and selling a weekly call option. And with this strategy, you can get started with about $3,500 to purchase 100 shares of an ETF or a stock and start selling weekly call options. Now, when you sell an option premium, cash is immediately credited to your brokerage account, and each week when we sell options, we collect that premium, which is actually cash going into our brokerage account. So, for example, if you sell an option and it has a 4-point premium, then $400 in cash is credited to your brokerage account. And that cash reduces the cost basis of the stock and reduces the overall risk of the trade. And what we do is when we receive that cash every week, that starts to build up, and then we purchase more covered calls, and we start to compound our returns pretty quickly. So selling these weekly options can lead to 100% cash on cash return regardless of the price movement of the underlying stock, and I'll show you an actual example of that right now in a few minutes here. So, for example, if you invest $3,500 in a weekly covered call, you could receive $3,500 in cash income over the course of the year. And these weekly covered calls have been profitable during various types of market conditions, non-trending markets, trending markets, volatile markets, non-volatile markets. So they've been pretty consistent performers. And this strategy incurs less risk than owning a stock or an ETF. So weekly options start trading on Thursday, and they expire the following Friday, and they have a trading life of 6 days. And as I mentioned, we have 52 opportunities each year to sell option premium. So this allows us to roll over our profits and compound our returns. So let's look at an actual trade example that we have on now. And this is the first part of a covered call, is buying 100 shares of a stock or an ETF. So our brokerage statement shows that we bought 100 shares of ERX. That's the leveraged energy ETF, and we paid $31.47. So bought 100 shares of ERX at $31.47. And the second leg of these covered calls is to sell to open a weekly option, call option. So our brokerage statement shows this was the same day that we purchased 100 shares. At the same time, we sold to open the ERX September 2nd 31 strike call at 110. So the September 2nd call, that was a weekly option. So that September 2nd call expired September 9th, and then we sold another option on September 9th. And this call was sold for 1.10. So after commissions, $101 was credited to my brokerage account. So we bought the 100 shares of the energy ETF, and then we sold to open the September 2nd weekly call. And what we'd like to do each week is roll over the expiring call option and then sell to open the new call option. So when we do that, we can keep the stock or the ETF in our account. So the way we roll over is to buy to close the expiring weekly option and then sell to open the new at the money weekly option. So here's some examples of this ERX covered call that we kept rolling over. So on September 2nd, we sold to open the September 9th weekly call at 165, so $156 after commissions was credited to our account. So the September 2nd call was expiring. We closed that out, sold to open the September 9th. And then we did the following week, we sold to open the September 16th. Then we just kept doing this, sold the September 23rd weekly option, September 30th, October 7th, October 14th. So these are just our actual rollover trades where we sold to open the new option. So over this 10-week period, we collected $1,264 in cash payouts after commission. So this averages out to $126 per week in cash payouts. And we invested about 31, we bought the 100 shares and we invested $3,156 to get this covered call trade started. So if we were to average $126 each week coming in times 52 weeks over the course of a year, we can collect $6,500 in cash. And remember, the initial cost was $3,156. So that's about a 207% cash payout based on our initial cost. So of course, this $6,500 in potential cash payout would help reduce any losses if the ERX ETF dropped in price, and we could wind up profiting whether the ETF was up, down, or flat over the course of the year, and we could profit even if we had bad timing when we entered the trade. So, and as I mentioned earlier, we like to compound our returns by using our cash payouts to purchase additional shares in ETF and then sell additional call options. So if you receive a 207% cash on cash return, a lot can go wrong and you're still going to profit from the trade. The underlying stock or ETF could decline 20, even 50%, and you could still profit. And if you had bad timing when you entered that trade, you could still profit. Now, there's always a risk of getting called with a covered call, but as I mentioned, each week we roll over that covered call, we buy to close the expiring call, sell to open the new call. So that way we get to keep the stock in our account. So there could be volatile price swings in the underlying stock or ETF, and you could still profit. So this gives the weekly covered call strategy a big advantage over directional trades that require the stock or the ETF to move in the right direction in order to profit. Okay, and we use three criteria for selecting ETFs for the weekly covered calls. We also trade weekly stock covered calls, and we trade weekly ETF covered calls. And when we're looking at ETFs to initiate a covered call, we look at three things. We want to make sure that the ETF trades weekly options. That allows us to collect 52 premiums a year versus an ETF that only traded monthly options when you would collect 12 premiums. And we'd like to see an option premium that gives you at least a 1 to 2% weekly cash payout from selling at the money calls. So if the stock is trading at $100, we like to see at least a 1 or 2 point cash payout every week from selling the at the money calls. And the last thing we look at is we want to make sure that the price of the ETF is trending up, and we just simply look at the 1 month price and make sure that's above the 10-month simple moving average. So these covered calls are neutral to slightly bullish strategy. We just don't want to do them on a stock that's in a price downtrend because there's too many good stocks or ETFs that are in a price uptrend. So we just look and make sure that the 1 month price is above the 10-month simple moving average just to make sure that the stock or ETF is in a price uptrend.